Welcome to XM.com. For this special report, we'll be looking at commodities and the factors that will most likely affect their performance in 2023. I'm Cristina Marujos. With me today is our lead investment analyst, Rafi Boyajian, and our senior investment analyst, Harala Bospisuros. Great having you both with me today. Let's start with gold. It looks like it surrendered its safe haven title to the US dollar this past year, even though concerns about the performance of the global economy remained elevated. But does it have the potential to reclaim its safe haven status in 2023?
Hello, Christina. Yes, to be honest, I think it does. But before I explain why, we need to understand why it lost the status in the first place. With inflation getting out of hand due to the supply shortages caused by the pandemic and the war in Ukraine, central banks around the globe set the fight against inflation as a priority compared to restoring economic activity. So, as interest rates around the globe rose at a fast pace this year, at least until a couple of months ago, the non-yielding gold lost its allure. The title of the ultimate safe haven was passed to the US dollar, as with the Fed raising rates more aggressively than other major central banks, it became the only safe haven currency that also offered high yields. Gold has therefore developed a positive relationship with equities and a negative one with the US dollar. That relationship is also the reason why the precious metal has staged such a comeback in November. With inflation in the US coming down faster than previously anticipated, investors have significantly lowered their expectations with regards to the Fed's future course of action. They agree with Fed officials that slower rate increases are warranted hereafter. But despite policymakers pushing against a pivot and data suggesting that the US labor market remains tight, investors are pricing in nearly 2/4 point interest rate cuts by the end of 2023. So, with all that in mind, a worsening of the global outlook in the coming months as the effect of higher interest rates continues to be reflected in the data could well weigh in equities, while the dollar could attract some safe haven flows, resulting in another leg south in gold. However, with the base effect of the rally in oil prices expected to drop out of the year-on-year consumer price calculations in coming months, headline inflation may continue to come down in 2023. This would add credence to investors' assessment of a potential Fed pivot sooner rather than later and may limit any losses in the yellow metal. So, combined with deeper economic wounds, expectations of lower interest rates during the second half of 2023 could even allow the metal to reclaim its safe haven status in an environment where yielding assets are not attractive anymore. Therefore, even if gold pulls back at the start of 2023, it could very well shine again thereafter, perhaps during the second quarter or second half of the year.
And let's not also forget geopolitical factors, because of course the war in Ukraine is still raging on. We're unlikely to see a major escalation, at least from where things stand at the moment, but of course it's something we cannot rule out, especially as the risk of Russia using nuclear weapons as things get more desperate for Russian forces, that is unfortunately that is a real threat, even if it's a low one at this point. And also the possibility of maybe China-Taiwan tensions. So these are factors that could potentially boost gold in 2023. Ultimately, though, like Harala said, it does come down to what the Fed policy outlook will be.
I see. Now, turning to industrial metals, they did have a volatile year, but with the latest news coming from China, with the relaxing of the COVID restrictions and, of course, the reopening of the economy, could copper and iron ore bounce back in 2023?
Yes, both those metals traded in a more volatile manner than gold and had a stronger link to changes in risk sentiment. The correlation coefficients, as well as the betas of both copper and iron ore with the S&P 500, have been higher than those of gold, with copper holding first place and confirming its global economic bellwether status, due to every major sector of the global economy using copper. That said, both metals may have an extra sensitivity to developments surrounding China. As the world's second largest economy, is the number one importer of both copper and iron ore, while it holds the third place in terms of production. Thus, further weakening or uncertainty, as Rafi said, of China's economy, and also further weakening of global manufacturing activity may keep weighing on industrial metals for a while longer. Yes, China has started loosening its COVID-related restrictions, but it may take some time for the engines of the economy to restart. In other words, it may take some time to see the positive effect. So when that happens, this is when we may see both of those industrial metals rebounding and edging decently higher. With that in mind, copper and iron ore may rebound at a later stage than gold if we want to have a comparison, as gold could enjoy some safe haven flows at a time when others are still feeling the heat of the deteriorating global economic activity.
And it's also going to be just interesting to see, because I don't think we've been in this situation before, that we're seeing all major economies heading towards recession. Will China, are we going to see recovery in China offsetting, say, weaker demand from, say, the likes of the US and Europe? So I think that's going to be really interesting to see how all of that is going to turn out in 2023.
Well, with analysts expecting a recession in 2023, how could oil perform, especially as the West has just upped the pressure on Russia with a price cap on its oil?
Well, Christina, I think it's all going to come down to how the supply and demand concerns pan out. At the moment, the combination of the energy crisis subsiding somewhat and the demand outlook deteriorating significantly, these are all weighing on oil prices. We've seen oil futures fall from their highs above $130 a barrel in March to below $80 a barrel at the moment. But heading into 2023, there are fears that the price cap on Russian oil will cause fresh supply issues. Russia has said it will not comply with the price cap. And although OPEC has signaled that it is willing to pump more oil should this additional sanction on Russia cause major shortages, there is still a substantial risk for oil prices to shoot higher from current levels. There's also an upside risk from Chinese demand recovering, as we were just talking about, as the government there slowly begins to ease its COVID restrictions. But this may not have a substantial impact until later in the year. And by that point, there's a high risk that most other economies will be in recession already. So it will come down to how each of these factors offset one another, hence why there's so much uncertainty surrounding the outlook. The one thing that's important to make clear is that even though oil prices have fallen a lot and we may see some further declines if the energy crisis continues to ease and the Russian price cap doesn't completely cut off its oil from the market, supply is still very tight and is expected to remain tight. So there may not be much downside left, whereas should the situation with Russia escalate or demand does indeed recover because the gloomy economic predictions don't materialize, then it is possible to see another oil rally at some point in 2023.
I totally agree with Rafi, and I would like to add that weather may be another factor to affect oil prices, as a harsh winter could increase demand for heating oil, but we need to wait to see how this factor plays out. And also, we need to take into account the possibility or likelihood or the chance, let's say, of a potential de-escalation in the war in Ukraine. If that happens, this could restore global supply to pre-war levels. But with what we have in hand now and with what we know now, this may be not a case for the turn of the year. Even if it happens during the end of the year, due to the many complications throughout 2022, we may not have an immediate effect on supply, and so if we have it, the escalation towards well into 2023, the restoration of global supply may be a story for 2024.
And based on the last two comments Haralambos made, Rafi, what could the new year have in store for natural gas, given that, so far at least, the energy crisis in Europe has not been as dreadful as initially feared?
Well, Christina, of course, the countries most impacted by the Russian sanctions that affect natural gas. Well, actually, firstly, we should point out that there aren't any direct sanctions on Russian gas, but Europe is, of course, that's most been affected by this. That's why European gas futures have surged the most in 2022. Now, these countries are making great efforts to switch to renewable energy and to find alternative sources of gas, particularly efforts are underway for Europe to import more liquefied natural gas from the United States. But this could take several years because it does require a lot of investment in new infrastructure, both for renewables and for importing gas by sea rather than through pipelines. So at the moment, of course, Europe has managed to build up its reserves. So even if this winter does turn out okay, there's huge uncertainty about next winter because Europe is not going to have the same advantage as it did this year in terms of starting early on stocking up. Because earlier this year we still had substantial gas flows from Russia to Europe. But those gas flows have dwindled. In fact, monthly flows are a fraction of what they used to be. And if Europe does use most of its gas reserves this winter, it will be difficult to stockpile again for next winter if Russian gas remains very limited. So for now, assuming that the situation with Ukraine doesn't change, gas prices could continue to stabilize, and if Europe survives this winter, it probably won't take long even then before we're having the similar discussion for next winter, and there's a high risk for another surge in gas futures in the second half of 2023.
Rafi, Haralambos, thanks so much. This was a special report, a Commodities Yearly Outlook, here at XM.com.